Good morning. This is Larry Edelson for my Uncommon Wisdom video for Thursday, February 11th. A lot of action again still in the markets, especially in gold, the dollar, and the Dow, which I've been tracking very closely for you over the last several months. It seems that indeed many of these markets have reached a turning point in late January as I expected. And we're seeing continued volatility since that turn in January. So with that, let's get right to the charts. I'm continuing the saga of the charts here because I want you to learn from my experience, from the patterns that I show you. And I keep these charts up here not only because I'm watching them, but for your benefit as well, so that you can see how these events and market moves unfold from week to week. This is the gold chart we've been watching now for several months. We saw the high back at 1267. I said there'd be a pullback. We got back to this cyclical trend line here, rallied a bit more, and then last week, well, prior to last week, we started to break down. Last week, it looked like gold was going to completely fall out of bed. Here's where we were last week, and I indicated to you that we had just touched a major support uptrend here, and we would likely see a bounce in gold, possibly back above this cyclical trend line here. And that's where we stand today. We've seen a pretty good rally back up to 1,080, after getting as low as 1,050 in gold. That is a very good sign. It is a good sign for the longer-term bull market in gold. If gold were truly super weak, we probably would not have seen gold get back above this confluence of two trend lines here and instead trade down to 1,030, perhaps even break this lower support line here, this cyclical support line here. But so far so good. We're starting to see some renewed strength in gold. The next couple of weeks will be critical. I believe we'll get back up to 1100, 1112, up into this region, probably come back down. And as I indicated a couple of weeks ago to you, we're going to chop around a bit here in gold before the next decisive move takes off. So for you core long-term gold holders, keep your bullion, keep your long-term core gold positions. Gold is heading much higher. I cannot overemphasize that. It's only the short term that's going to be very, very choppy. Let's take a look at the dollar now. The dollar, as I showed you last week, pulled above, thrust above this cyclical resistance line here and looked very, very strong. But lo and behold, look what's happened in just the last few trading days. The dollar's fallen back down to its short-term 10-day moving average here and will probably be drawn back down to 78.25, this convergence of these two lines here. Whenever you see important trend lines on a chart that converge, it tends to act, the intersection of those two lines tends to act as a magnet for prices. And I believe we have a magnet cluster right here that we will probably test over the next week or two in the dollar, with the dollar falling back down here. Then we'll probably trade sideways for a little bit more. Remember, the intermediate, short-term and intermediate-term cycles and trends for the dollar are choppy to slightly higher. The long-term trend for the dollar remains decisively down. Moving on to the Dow, this is the chart I've been following for some time with you. On the Dow, last week we were in this area right here. I said we'd probably move a little bit lower and indeed into this white space here. We found support at the low end at 98, what was the low that day? 98.35, and rallied back and closed so far above the 9,900 level. That's important because I have some sell signals just under 9,900 in the Dow that have not been hit yet. And that indicates to me we'll probably rally back up to 10,368, maybe even 10,006 in the weeks ahead before testing the downside again. Too soon to say. We could see the Dow roll over here and go all the way down to 9,400 or so. I don't expect that. I expect a further choppy rally in some zigzagging pattern here. And quite likely a move in a few weeks down to 9,400 or lower. But it's too soon to take on any aggressive short positions for that type of scenario. We will know soon enough, and I would not jump ahead of my signals on that. I will let you know. Couple other markets, we've seen oil. Let me bring that chart up for you. Oil holding in this general area, low $72, $73 area. This is a double bottom type of formation. It should give birth to a short-term rally, but I do suspect over the next several weeks that we will see this double bottom formation taken out and an attempt lower at the $68 level down at this low here. So oil's not out of the woods yet. Long term, it remains in a bull market with substantially higher prices to come. Short term, we're seeing the winds buffet oil around just like they're buffeting around a lot of other markets. The name of the game is going to be volatility for the next few months. We are going to see continued wild swings for very short-term traders. That can be very, very good. For intermediate-term traders, that can be very risky. We can have what I call chop city. And for long-term investors, it's a dangerous time because it's very easy to get shaken out of the right positions in this market. So if you're a long-term investor and you follow my intermediate-term and longer-term recommendations in my publications such as Real Wealth Report, please stay tuned to that and publication and flash alerts and my videos here so that I can help keep that long-term perspective into you. You do not want to get shaken out of good long-term positions just because of volatility. It is times like this when the markets are swinging like crazy where it's often better not even look at the markets. If you look at them every day and you're a long-term investor, you're better off looking at them once a week, provided, of course, you have appropriate risk measures in place, stops, protective stops, etc., and you have a professional managing your money. With that, have a good weekend. Till next week, this is Larry.